Let's dig into the details of this emergency rate-setting meeting. Jonathan Ofeyan, and publisher of the Africa Briefing magazine, is joining us live on the program for more analysis on these developments. Mr. Answer, good to have you on the program tonight. So the MPC had this regular scheduled meeting 11 days away. What has changed in the country's economic landscape that would warrant moving that meeting forward to today?
Well, I believe the Bank of Ghana likely brought the meeting forward because the economy is showing clear signs of improvement. Inflation has dropped to its lowest point in over 3 years. The cedi has stopped falling and is now stable at around 10.40 to the dollar. And the country's foreign reserves have also grown to over $11 billion. So these are all positive signs that may have convinced the bank that it is the right time to review interest rates earlier than planned. And I think that acting now may also help the bank stay ahead of any unexpected external shocks, like changes in global interest rates or commodity prices.
So economists surveyed by Bloomberg expect the MPC, at least this was before we knew about this emergency rate MPC meeting, they expect the policy rates to be cut by around 300 or so basis points, bringing it down from 28% to 25.5%. Do you agree with that view?
Well, the forecast seems reasonable, but I think the bank may go for a smaller cut, maybe something like 1.5 to 2 percentage points instead of the touted full 2.5 or 3. Yes, inflation is coming down. The cedi is stable, which supports a rate cut. But the bank tends to be very, very, careful. You see, there are still risks to watch, like higher fuel and food prices globally, possible pressures on government spending, and the need to keep investor confidence high. So I think that the bank probably will want to move slowly to make sure that the gains made so far are not lost.
Indeed. One last question for you, sir. A sharp rise in gold prices has also helped Ghana to raise FX reserves to where they are now. $11.1 billion was the recent number that the BOG governor made public. How, though, can Ghana hedge against a collapse in bullion prices, which in turn would cut its trade surplus and all the dollar inflows that have helped to essentially buff up FX reserves by over $2 billion since the start of the year?
The strong gold earnings have actually, like you rightly said, has boosted our foreign reserves to over 11 billion, which is quite great, actually. But gold prices tend to go up and down. So, the country needs a plan in case prices fall. And one option is to use hedging, basically locking in future gold prices now through contracts so that even if prices fall later, Ghana doesn't lose out. Another solution is also to diversify, the economy, relying less on gold and boosting other exports like agric and manufacturing, which could actually reduce the risk, Ghana might encounter. And it can also keep, using good times like this to build up the reserves, so that it has a buffer when conditions turn. And again, finally, I think it needs to be smart with how it uses the extra money. Saving more and avoiding unnecessary spending will make the economy more resilient should gold prices take a hit.
Indeed, staying to the path of fiscal consolidation, as it were. We'll leave it there for the time being. Jonathan Ofeyan, founder and publisher of the Africa Briefing magazine, joining us there live on the program.